Welcome back. You're watching the ET Money Show, and it gives me pleasure to introduce my next guest, Pankaj Bansal, Chief Business Officer of bankbazaar.com. Thank you so much, Pankaj, for taking the time. I want to jump straight into the conversation which relates to rising interest rates, because I think this is something that impacts all of us. This fight against inflation, of course, is important, but with rising interest rates, thankfully, we are moving towards a scenario where we'll see real interest rates finally. And that is a good deal for a lot of retirees, a lot of people that are dependent on interest income. But before we get to that, I want to understand from you, a lot of people talk about the power of compounding, but maybe not enough people appreciate its benefits. How would you describe this and how do you explain it?
Sure. No, Alex, I think this is a very interesting topic to talk about for consumers because this power of compounding is so powerful. And if I'll give you some numbers that will blow off your mind. So if you look at power of compounding today, I'm just giving you an example, an illustration for the benefit of the consumers here is that assuming if I invest about 1 lakh rupees, right, in 30 years of age, at a 10.3% interest on an annualized basis, the number after 60 years and I'm doing my retirement will be awesome, about 3 crore rupees. Okay, this is the amount of money that the power of compounding can make, right? Over a bit of time, if you look at it, maybe if you take it to about 15%, it'll be like 3.5 crores that you can make out of it. Second piece that I want to talk about power of compounding is same thing. If I do it at 40 years rather than 30 years to 40, 50 years as my age, it'll be very, very different numbers. So if I put it the numbers in perspective, exact numbers, 30 years, if I invest, I take it 1 lakh rupee, just put 1 lakh rupee in 30 years of age. After 20 years, if I withdraw that money, it will be 16 lakh rupees that we'll get. The same amount, if I do it in 40 years, I'll just get 4 lakh rupees at a 1 lakh rupee. So this is on one-time investment. Now come to SIP. For example, if I do investment for 12,500 rupees at 30 years of age for a monthly basis, okay? If I put that number for about 30 years to 60 years, I'll get about 3 crore rupees out of it. That is the number that I think will come on a SIP basis. So, and if I do the same investment in 45 years, I just get about 53 lakh rupees on a 12.5%, 12,500 rupees EMI on a monthly basis with a 10.3% interest. So this is how a drastic difference you'll see in compounding will happen. So in the first example, one-time investment of 1 lakh will take in 20 years from 30 to 50 years, 16 lakh. The same investment, I do it in 40 years to 50 years with the same amount of interest, which is compounded about 15%, and the same 1 lakh rupee, it'll just be about 4 lakh rupees. So look at the gap in the compounding from that perspective. And in the second scenario, when you do SIP, for example, you invest every 12,500 rupees per month for a period of 30 to 60 years, the corpus that you arrange at a 10.3% kind of a number at an interest level or the return level would be about 3 crore. The same if I do it at 45 years of age, and if I do 60 years of as my retirement age, I'll only get 53 lakh rupees here. So this is the difference. If I have to get the same 3 crore, when I invest at 45, I have to either invest till 75 years of age, or I have to make a return of 27% to get the 3 crore in the same time frame. So this is how a vast difference on the entire compound effect is. So first example, one time 4x on SIP also, if you look at 53 lakhs against, I would say 3 crores over a period of 30 years. So this is how a compounding effect is. And the last one more example I can give you is if you want to have the same 3 crore with 10.3% interest on a SIP, that 12.5 SIP in 45 years has to move to 70,000 rupees of SIP in 45 years. So these are few examples which is clearly indicative of how a multiplier effect is there on a compounding that you do in the scheme of things, whether on a SIP or whether on a one-time investment.
Very nicely explains it, Pankaj. I think that very nicely explains the concept of compounding. But when we're talking about deposits, which a lot of people gravitate towards because of the simplicity of the product and because it's familiar, even in these fixed deposits, there are certain different types of interest payments and compounding methods. Some of them, in fact, compound on a monthly basis. Some, in fact, compound on a quarterly basis. How do you identify which one is right for you?
So whenever you do a compounding, right, you should do the compounding with a minimum this thing. So for example, if I'm doing a compounding on a monthly basis, assume I invest 100 rupees and the interest on that 100, I'm just taking a number is 10 rupees. So next month there will be 110 rupees which gets added and the interest will be paid on that 110. If it's quarterly, if it is annually, or if it is cumulative. So the lesser the tenure from that perspective, from a compounding, the more impact you will see on your overall income that you make. So whenever you do this, the only suggestion I make to the consumers here is that do it at a monthly. If it's a monthly compounding, let's do it on monthly so that you earn the interest on the entire compounded effect. And it will be a huge number of 5 years. You will make a lot of difference in your overall throughput when you do a redemption of that particular FD. So monthly, you should do it on the compounding effect as far as possible. Somebody gives quarterly, do it quarterly. But between the four options, the lesser the tenure in terms of monthly, choose monthly. If it is quarterly, choose quarterly, whichever is earlier, I would say, from a compounding benefit that a consumer should get. So I'm looking more from a consumer standpoint.
Pankaj, we're talking at a time when the central bank has already, over the course of a couple of months, increased the policy rates by 90 basis points.
Yeah.
So the first question here is, how many banks have already passed that on? And the second question is, with the expectation of interest rates going up even further, especially for those that depend on interest income, how should they structure their fixed deposits? Because there is the potential to earn more. They shouldn't get stuck or lock their money in for long periods of time, right?
Correct. You're right, Alex. I think most of the banks have passed on the deposit rates and they have raised their deposits, whether it is PSUs, whether it is private banks, whether it is, small finance banks. So most of them have done it with various benchmarks. Somebody has done it from 40 basis points to 50. Somebody has done from 15 to 25, depending on their cost of funds position, to be very honest with you. So FD is not a direct repo link, except one cases that we know today. But broadly, FD is a function of your cost of funds movement that the bank looks at and the amount of liquidity the bank is sitting on. So you will see that, for example, 90 basis points repo rate has risen, but the FD rates have not moved to that level, and it will take time. It will gradually move. So it will not be like a ripple effect within 3 months. The moment your loan gets, at a higher interest rate, your FD will also be the same interest. It will not happen like that. It will take some time. It depends on a bank's liquidity and a cost of fund position, based on which this is being passed on to the consumers. So that's point number one. Point number two, if you talk about the strategy, everybody knows that these deposit rates, I think, will go up here from here itself, because your interest rates also go up from here, because obviously RBI has passed on some repo rates have increased from 4% to 4.9 in the last 2 months, and we are expecting few more rises to happen. So when the repo rates will also go up, obviously, the liquidity in the market will get tightened. Obviously, you will see the banks, cash balance positions in terms of the cost of funds, and also they will try to mobilize more cash because obviously they're lending now. So this will happen, that banks will also raise the deposit rates. So I would suggest to consumers that they can invest with short term right now. The moment the redemption happens, they can redeploy that fund after redemption with a new higher rate of interest over a period of time. So I think the scenario rate increase is going to continue. It's a phenomena which we think will continue for some time. So you should wait for the right moment. Your deposit rates should rise further and further from here, the way your interest rates on the loans are rising, and you can redeem that benefit over a period of time. So invest in short-term FDs, redeem it, and then reinvest it into your long-term FDs with a better interest rate.
Okay, when you say short term, you mean about a year would be sufficient, right? And this other point that I want to make is, and this is the last point on deposits, is that Yes Bank has just launched a repo linked deposit, fixed deposit, 18 months or thereabouts. And I guess that this makes sense for banks to do, right? So would this make sense from the perspective of a depositor, especially in a rising interest rate scenario?
Yeah, so I think you're right, Alex. This is one of the rare products that some banks has come up in terms of linking directly with the repo rates. They are clearly articulating as a transparent move that the moment your repo rates will rise, we will also rise your deposit rates. So this is that kind of product. It, I think, starts from 1 year to 3 years broadly. So my view here is that obviously it's again a position, it's a commercial call that a bank has to take. So what they have understood is that, from the bank's perspective, that obviously the rates are going to rise. So based on the rates, their FD rates will any which go up. So they have put it as a product. It's a product in place, and it's good for the consumer. I think Yes Bank has got one of the best rates in terms of the deposit mobilization they're doing, and the reasons are well known for the company. So I think it's a good thing for a consumers to look at it from a long term perspective, and even further when they will see more raise rates on the repo side, they can reinvest that money from wherever they have cash liquidity coming in.
All right. I think that broadly covers all of the aspects on the deposit side. And of course, it's important to bear in mind, Pankaj, that the loans also get costlier. And we've spoken in the past about how you can manage that increased cost. Prepaying is always important, and choosing to increase your EMI is always better than increasing the tenure of the loan. But thank you so much, Pankaj, for joining in and for taking the time.
Thank you so much, Alex. Have a good day.